The perfect retirement withdrawal method. Does it even exist? In this video, I'm going to go over some of the common myths that are limiting with respect to how people are choosing to live their lives in retirement. A lot of it based upon some of the older, more traditional methods of retirement planning. And then I'm going to juxtapose that to the newer types of methods that are more geared to answering two basic questions. Not just, am I going to run out of money before the end of my life? But then also, am I going to have more money than what I thought? And should I spend a bit more to do the things I want to do now? So in this video, I'm going to go through two different types of methodologies on how it is people can make the decisions as to what they want to spend to lead their lives in retirement successfully. I'm going to use an example of John and Sally. John are recent retirees in the year 2025, and they're both over the age of 65. They've saved well over the course of their years, and like most Americans, they have the vast majority of their retirement savings parked in things like 401ks and IRAs, with a certain amount of money in some bank accounts and brokerage accounts. And this is really kind of the starting point for how it is that they can look to see what their money has the capacity to provide them while they move into their retirement years. In utilizing a more traditional approach, this is going to take a look at what likelihood that John and Sally have and their money's ability to be able to provide them a certain amount of income for the rest of their lives. So, in this case, on the proposed plan side, what likelihood is that level of money able to produce a certain amount of money for them? And I use the 4% withdrawal rule in this case under the proposed plan, which in their case translates out to be about $12,330 per month. So, in this case, if they were to spend roughly 4% of the value of the portfolio over the rest of their lives, adjusted for inflation, they'd have a high likelihood that they'd be able to keep up with that type of spending plan. However, what I want to do is I want to call your attention to this bar chart. And what this is saying is that there's a chance that John and Sally could leave a substantial amount of money to whoever they choose to leave it to. And that also means that maybe over the course of their retirement, they didn't spend enough of their money. Maybe they made compromises or didn't have the experiences that they wanted to. The point here is this could lead to a really high level of regret. So even though the probability or likelihood of success may feel good, that, all right, I know I'm not going to run out of money, it's not in any way, shape, or form addressing how it is that they may regret not doing certain things if they choose to. Just for this example's sake, I wanted to just compare it to this current plan and say, well, what if they had spent $15,000 per month and they had a slightly different way of claiming Social Security? Even in that case, even at a lower, at a 6 out of 10 chances it's successful, they still have a relatively high portfolio value moving on to the next generation, which again could lead to some regret with respect to whether they were able to do the things that brought them joy, which is the next point that I'm going to bring up. Typically, and what I found in practice is that people spend money not just in some straight line method where they're going to, in the case that we just looked at, where they're going to spend $12,300 or $15,000 a month every single month for the rest of their lives. People tend to have phases of retirement. In the first phase, it's gotten this moniker of the go-go years. The go-go years are typically where people are spending a bit more, maybe even more than what they were spending when they were earning heading into retirement, because there's things that they want to do that require money, and there's experiences that they want to have, and that's going to require them to use a certain portion of their nest egg. After that period of time, things slow down a little bit, and it's more of the slow go years where, because of health span declining and just maybe having checked off the boxes of a lot of different types of things, the spending tends to get a little bit lower. And then in the no-go years, toward the later end of stage of retirement and toward end of life, the spending tends to go down dramatically until certain healthcare costs kick in. So that's more of a typical type of curve when it comes to people spending in retirement. The other aspect, too, is that the human body ages not just in some gradual line that's kind of sloping to the end where we're not here. What ends up happening is that we age in plateaus. And so for a certain amount of years, you'll have a certain level of health in your health span, and then it will decline. And then those plateaus are almost like a stair step heading downwards. So that's different for everyone. But at the end of the day, it's taking a look at a scenario whereby what are the things that you want to do? How healthy do you need to be to enjoy those things to their fullest? Skiing the K-12 at a certain age where you're able to do it can bring you a tremendous amount of enjoyment. And maybe you do 20 runs over the course of a weekend, but you put 10, 15 or so years on there, it may not have the same level of enjoyment. You may not be able to spend the same level of time that you did maybe when you were 10 years younger. A way to look at this a little bit differently is to take a look at a calculator that's going to encompass more of that typical spending pattern in retirement, more in the earlier years, less in the later years. So in John and Sally's situation, I've basically made identical scenarios using a slightly different tool. So everything is the same with respect to the balance, the mixture in stocks and bonds. However, their spending capacity is very different because this tool is assuming that they're going to be spending more in the earlier years of their retirement. So in the last example, I'd started with the 4% rule, which is that common rule of thumb, but it's also very limiting. In this case, this is up over 7% in the earlier years of their retirement. And so, depending upon what type of retirement John and Sally are looking for, and I tend to find in practice that coming up with a number as to what people want to do in retirement is a very difficult type of scenario. And the guidance that's really helpful at that stage of the game is to give them some opportunity to kind of place numbers within a range. And so what we've seen here from the very conservative, the traditional type of planning is that 4% method is roughly 12,300. This, a little bit more in the truer spending capacity, is around $22,000 per month. So somewhere in that range is the safety zone. And then John and Sally can determine within that how it is that they want to be able to structure their retirement. Importantly, in this scenario, nowhere in this type of calculator is it going to inform John or Sally or their planner as to what they need to do if the markets go up, or more importantly, if the markets go down. It just says it's assuming a certain type of bouncing around of the portfolio value over the rest of their lives. And that because of that bouncing around, they have a fairly good likelihood in either case that they could spend between $12,000 and $15,000. But what do you do when things end up not going so well, like at the turn of the century when the tech bubble burst and when the great financial crisis hit in 2009? What is it that you need to do? Unfortunately, the traditional method of retirement planning gives no guidance as to how to be able to do that, but the more modern type does. In this scenario, what this is taking a look at is, in essence, creating some guardrails to the high and the low side. So, if something happens in the market, and the portfolio value declines, it actually gives some guidance. So where John, Sally, they can be a bit more proactive to say, what is it that I need to do and what consequence does a down market have to them at any point in time? So in this case, if the market, in conjunction with what they're spending, was to lose over $1 million of value on their 3.7 million, they would have to reduce or think about a different type of spending plan, reducing about $1,100 per month. Now, the flip side to that coin is if the portfolio was to increase in value and it was to increase over $250,000 or 7%, they could think about enhancing and increasing and giving themselves, in essence, a bonus of $1,600 per month. And this may sound very different because I know from firsthand experience in 2000 to 2002 and 2009 to 2010, there were a lot of decisions that were being made based upon how bad the markets were. And people were just in plain, flat out survival mode at that period of time. What this offers is an opportunity to say, in the midst of a really scary market, what is it that you actually need to do? What kind of compromises do you need to take? Because during those periods of time that I mentioned, people were cutting budgets almost entirely. People were setting additional years into their retirement timeframes. They were making very, very severe decisions with respect to do what to do with their money. This newer method of taking a look at spending capacity offers an opportunity to be a bit more proactive and also juxtapose it to what things have happened in the past to see over the longer term how things operate over the course of the entirety of one's retirement. So a useful way to say, well, what if something bad happens in the near future? What is it that means with respect to my retirement plan or my spending in retirement? So I think for many of us, that great financial crisis from 2007 to 2009 is one of the bigger market declines that has been experienced since the Great Depression. And in that case, if somebody had retired in November of 2007, right before things started to get ugly in the global financial crisis, what would they need to do? So what we're taking a look here is the income plan. If they had retired with the same amount of money that John and Sally have, roughly $3.7 million, and where those guardrails would be. So, based on a portfolio that they have, which is 3/4 in stock, 1/4 in bonds, this is taking a look at historical values of a typical portfolio over that period of time. And over that period, what you see here in the middle is that blue line is their portfolio, and the green area is the upper end of their guardrail, and the red area is the lower end of that guardrail. And because of their configuration in stocks and bonds, they came very close to that lower guardrail in March of 2009, which was the bottom of the great financial crisis. But they never went through that lower guardrail, so they never really needed an income adjustment to their portfolio. As crazy as that may sound, if they were looking at it from this perspective and said, all right, that 3.7 did drop to roughly 2.3, which is a big drop, certainly scary nonetheless, but it wasn't to the point where they would need to make some type of decision as to what their spending would look like. Now, granted, this is taking a look at what the market has done. So if there is, which there will probably be several in the course of, if somebody's retiring right now, they are going to live through at least 2 very bad market declines over the course of the rest of their lives, and probably more than that. So it all depends upon what that recovery looks like. However, if we look at past periods like the great financial crisis, the markets do recover. And from that standpoint, it's just staying invested and then also staying true to where it is that your withdrawal plan is going to be offers the best opportunity to be able to make it through that. When it comes to a retirement planning scenario or a withdrawal plan, spending plan, or how it is that you're going to get a direct deposit within retirement, a lot more planning needs to be done than what we looked at here. This is just the first glance to come up with what a budget might look like and what type of withdrawal plan is going to suit best your tendencies, thoughts, attitudes, and behaviors. But I hope I've made the case here that the traditional way of looking at it may be a great place to start, but it isn't really indicative and true of how it is that most retirees spend. And it does leave a lot on the table with respect to compromises that can lead to later life regret. Didn't make that trip, then couldn't go on that trip. That can lead to a lot of regret later on in life, which just defeats the purpose of all of that sacrifice that you've made with respect to saving to get to those points to have the kinds of experiences that you're looking for. So if you like this video, hit the old thumbs up, subscribe to the channel as I publish more information about how it is that you can retire well.